Are you a homeowner in the UK looking for a way to access a significant amount of money for home improvements or debt consolidation? Well, you're in luck. In today's video, we'll be discussing an option which might be just right for you. The best cheap second charge mortgage advisors in the UK. Let's start by understanding what a second charge mortgage is and how it can benefit you. A second charge mortgage allows you to borrow money while keeping your existing mortgage. It's a secured loan that is primarily aimed at homeowners who have a good amount of money or equity in their property and want to borrow a substantial amount of that money. However, it's important to note that this type of loan may not be available to those with negative equity in their home. Now you might be wondering, why would you apply for a second charge mortgage? Well, there are several reasons why this option might be appealing to you. For instance, if the principal mortgage on your home has been or will be repaid early, but you don't want to remortgage the entire property, a second charge mortgage can be a great alternative. Alternatively, you may not be able to remortgage with your existing lender, but you could qualify for a second charge mortgage from another lender. Furthermore, by borrowing from second charge mortgage lenders, you can enjoy lower interest rates compared to personal loans or a credit card. Let's talk about the cost of a second charge mortgage. Several factors determine the cost, including the amount you borrow, the loan term, the interest rate, and any associated fees or charges. Since second charge mortgages pose an additional risk for lenders, interest rates can be higher than those for primary mortgages. Currently, second charge mortgage interest rates in the UK typically range from about 3% to 10%, depending on circumstances. It's important to note that these rates can vary significantly based on your own financial situation. Additionally, there may be additional fees, such as arrangement fees, valuation fees, legal fees, and early repayment charges, so it's crucial to carefully consider all of the costs involved before you make a decision. Now that we've covered the basics, let's explore how you can find the best cheap second charge mortgages in the UK. The key is to compare different lenders and mortgage products. Here's a step-by-step guide to help you in your search. Step 1. Start by researching different lenders that offer second charge mortgages in the UK. You can use a comparison website or seek the assistance of a mortgage broker to explore a range of options. Step 2. Identify lenders offering the lowest rates on second charge mortgages and compare them to the rates offered by your primary mortgage lender. Step 3. Take into account all the fees and charges associated with the mortgage, including arrangement fees, valuation fees, and legal fees. These additional costs can significantly impact the overall affordability of the mortgage. Step 4. Before applying, ensure that you meet the eligibility requirements of the lender. This may involve criteria related to your credit score, income, and other factors. Now that you know how to find the best cheap second charge mortgage lender, it's important to consider whether this option is right for you. Here are some factors to keep in mind. You need to assess your income, debts, and overall financial stability. Only take a second charge mortgage if you can comfortably afford the repayments. Consider the purpose of the funds you want to borrow. While second charge mortgages are suitable for home improvements or debt consolidation, they may not be ideal for other borrowing needs. Evaluate the repayment term and whether it aligns with your financial situation. Longer repayment terms may result in lower monthly payments, but higher overall costs. Compare interest rates and fees from different lenders to secure the best possible deal. Keep in mind that depending on your primary lender, second charge mortgages may not be allowed due to existing mortgage restrictions. If you have significant equity in your property, there's another alternative you could consider: a home equity line of credit, a HELOC. A HELOC can be a better option than remortgaging if you qualify. The interest rates are generally lower and the repayment terms are more flexible. You can use an online HELOC calculator to assess the potential benefits and determine if it's the right choice for you. If you're interested in finding a loan for your circumstances, then simply click the link in the description below and fill out the short form. It contains a few questions like whether you're a homeowner and how much you'd like to borrow, and it will give you access to quotes from around the UK tailored to your circumstance. It's totally free to do, and of course it won't affect your credit score. So click the link in the description below to fill out the short form to try it out.